Welcome to the Deep Dive. We take the latest, most complex corporate announcements, tear them apart, and deliver the concentrated insights you need.
And today, we're tackling the second quarter 2025 earnings for PROS. They reported July 31st, after hours.
Yeah, and this one's a bit of a head-scratcher, isn't it?
It really is. You've got, management delivering what looks like a textbook quarter, beats across the board, raised guidance, pretty clean execution.
Super clean. But then the market reaction suggests, a lot of skepticism. Deep skepticism, actually, about whether they can really grow faster.
Exactly. That's the divergence, right? The numbers look good, guidance is up, but the stock takes a hit.
We absolutely have to unpack that. Because they didn't just beat, they crushed profitability estimates, raised the full-year free cash flow target by a huge margin, cleaned up the balance sheet.
And yet, the stock closes the next day down 5.1% on pretty heavy volume, too.
So the market's basically yelling, show me faster subscription growth, or this operational stuff doesn't impress us.
Okay, let's nail down the facts first before we get too deep into the sentiment. PROS did significantly outperform. Non-GAAP EPS came in at $0.13.
Which was way above the $0.06 consensus, like double.
Right. Total revenue was $88.7 million, also just edging out expectations.
And the quality of that revenue looked pretty solid, too. Subscription revenue, which is really the key thing everyone watches.
Yeah, the main engine.
It grew 12% year over year. That's $73.3 million. And recurring revenue is now, 86% of the total? Up from 84% last year.
It's a good trend, shows stability. And that base seems sticky, too. Trailing 12-month gross revenue retention is still holding above 93%.
Rock solid, yeah.
So you look at just those numbers, the operating metrics, you'd probably be pretty happy, right?
You would think so.
But investors are laser focused on that growth engine. And recurring calculated billings? Yeah. Well, they only grew 5% year over year in Q2.
Okay, so that's the number maybe giving people pause.
I think so. When you beat guidance everywhere, raise the full year, but the stock still drops, it's telling you that the current ARR growth, annual recurring revenue growth,
which is still low double digits, like that 11-12% range.
Exactly. It's just not fast enough. Not enough to justify the kind of premium investors usually want for software stocks like this.
Okay, so if growth isn't getting rewarded right now, maybe the focus should be on profitability. Let's dive into the financials because, honestly, the operational leverage story here is quite something.
It really is. Non-GAAP gross margin hit 69%, and that was really driven by the subscription side, which had an 80% non-GAAP margin. That's pretty strong.
80% on subs is excellent.
It's a profound margin expansion story playing out. Adjusted EBITDA jumped 42% year over year to $7.4 million.
Wow, 42%. So that really showed the efficiency gains are hitting the bottom line.
Definitely. The expense structure seems to be stabilizing, and that leverage is clear. And, that's kind of the foundation they need for the next phase of investment.
Right. Stability funds the future. And that stability means cash. Free cash flow, FCF.
Yeah.
The actual cash left over after running the business.
And paying for CapEx. Yeah.
It was $3.2 million for the quarter. But maybe more importantly, FCF for the whole first half of 2025 was $4.3 million. That's a big turnaround from last year.
Huge improvement. And that cash performance gives them cushion for the strategic stuff we'll get to. But equally important, I think, is the balance sheet discipline.
Okay, yeah. They ended Q2 with, $189 million in cash and investment?
Correct. But the really slick move was on the debt side.
Right. Tell us about that balance sheet cleanup. It sounded a little complicated. They swapped out notes due in 2027 for new ones due in 2030.
Yeah, basically. They exchanged about $187 million of those 2027 convertible notes for $185 million due in 2030.
So it's not just kicking the can down the road 3 years. What's the real benefit?
Well, that's the key. It wasn't just a refi. They actually managed to reduce the total debt principal slightly by about 12% once the old notes are fully retired.
Oh, interesting. So less debt overall and more time.
Exactly. Extends the runway dramatically out to 2030. That gives them much more financial flexibility, takes a near-term pressure point off the table. It definitely lowers the kind of floor risk for the stock.
But it doesn't solve the growth problem.
No, it doesn't solve the growth equation. Which brings us to the new CEO, Jeff Cotten, and his plan.
Right. Transitioning from efficiency to the growth roadmap. Cotten laid out 3 main focus areas, trying to tackle that market skepticism directly.
First one, putting more rigor into the top of the funnel. Basically, improving lead quality, getting better conversion rates. by aligning marketing campaigns much more specifically to industry subsegments, like getting really granular within manufacturing, for example.
Okay, more targeted marketing makes sense. What's number two?
Expanding their reach in key verticals. They specifically mentioned rebate management as an area with potential, which kind of fits naturally with their pricing stuff.
Okay, and third?
Doubling down on real strategic platform partnerships, getting broader distribution without just hiring more salespeople.
Okay, that first point about rigor at the top of the funnel, it makes me wonder, is that just CEO speak for saying the old sales and marketing spending wasn't working very well? I mean, they just generated better than expected EBITDA in the first half, right? But now management says they're taking that cushion and pouring it back into more sales and marketing in the second half.
That's a really sharp observation. And yeah, that's precisely the trade-off they're making. It's growth versus short-term margin.
Sacrificing profit now for growth later.
Essentially, yeah. Management's saying, look, we proved we can be profitable. Now we're reinvesting that cash into smarter, more targeted campaigns to drive growth.
But investors are clearly nervous. They need proof this new spending works better than the old spending did.
Right, exactly. They need to see that acceleration.
Okay, let's look at the innovation meant to help drive that growth.
Right.
The big reveal was these PROS AI agents.
Right. And management was pretty clear, these aren't just chatbots. They're trying to go beyond basic conversational AI.
How so?
They're blending large language models, LLMs, with PROS's own numerical optimization models, the stuff they're already good at.
So the idea isn't just to answer questions, it's to actually do things.
Goal-oriented execution, that's the term they used, for complex stuff like pricing decisions, handling rebates, configure price court, or CPQ processes.
Automating the tricky decisions that usually need an experienced person.
That seems to be the goal, taking the expert knowledge and embedding it in the AI.
And how are they going to make money off this? The monetization path seems, well, patient.
Very patient. Pilots start in Q3, but they said the focus for now is purely on getting people to use it, driving adoption.
So no revenue impact this year?
Not really. The model down the road is expected to be usage-based or maybe outcome-based. So it's definitely a longer-term catalyst, not something boosting 2025 numbers.
Okay, so AI is for the future. What about getting broader reach now? You mentioned partnerships.
Yeah, and they announced a pretty significant one already, a new partnership with Commerce, which used to be BigCommerce.
Oh, okay. What's the integration?
They're embedding PROS's enterprise pricing and CPQ features directly into Commerce's e-commerce platform.
That sounds potentially huge.
Yeah.
Marrying complex B2B pricing with a big e-commerce channel.
It could be. But the rollout has stages. It starts as co-selling and referrals.
Meaning PROS and commerce sales teams work together on leads.
Right. The longer-term vision is to move to a reseller model, where commerce sells it directly.
Okay, that transition to reseller is key then, because relying on partners always has some risk, right? Like, how much will they prioritize it?
Absolutely. Channel partnerships can be tricky. But if it works, it potentially opens up a massive new customer base for PROS's high-margin software.
Without them having to massively scale their own direct sales force overnight.
Exactly. It fits that operational efficiency story. Leverage the partner's reach.
Okay, what about the current business? Did they talk about customer wins?
They did. Momentum seemed pretty solid. Highlighted some big new B2B names like Lennox, Louis Dreyfus, RHI, Magnesita.
And they're still strong in airlines, right? That's always been a core area.
Definitely. They signed new carriers like Air Greenland and ValueJet, plus expansions with big ones like American Airlines and Scoot. The airline industry is going through a lot of change, and that whole offer management complexity plays right into PROS's strengths. Still a key differentiator for them.
Makes sense. So all the success, the beats, the new initiatives, it leads into their raised guidance for the full year. And this is where the disconnect with the stock price gets really stark.
Totally. Guidance up across the board. Total revenue target now $360 to $362 million.
Okay. And subscription ARR?
Raised to $310 to $313 million. That's roughly 11% year-over-year growth at the midpoint.
Still that low double-digit number. But the profitability metrics.
That's where the numbers get really impressive. The free cash flow guidance, they raised it to $40 to $44 million.
That's the huge jump, right? A 61% year-over-year improvement at the midpoint.
Massive. And adjusted EBITDA also raised to $42 to $44 million.
So if they're hitting those kinds of cash flow numbers, that kind of margin profile, why is the market still treating them like a struggling growth company?
Well, partly it's that focus on the source of the cash, that modest 11% ARR growth. And partly, management themselves kind of tempered expectations.
How so?
They confirmed the macro environment is still challenging. specifically mentioned project delays, deals pausing, especially outside the US.
So international headwinds.
Yeah. Now, they argue their software is actually more valuable when things are volatile with tariffs and uncertainty.
Because it helps companies manage pricing complexity.
Right. But even if it's more valuable, those tough environments still tend to slow down how quickly companies sign big new deals. Sales cycles get longer.
Okay, so you have this picture. Great execution, strong cash flow guidance, cleaned up balance sheet, but lingering macro worries, questions about the new S&M spend effectiveness, and a market fixated on faster top-line growth.
Which brings us perfectly to maybe finding a signal in all that noise.
All right, time for our segment where we look at potential mispricings based purely on the info we've just discussed. And remember, folks, this is just analysis, definitely not investment advice. This is not financial advice segment.
Okay, so the core idea, the thesis here, is that maybe the market is just way too focused on that near-term revenue acceleration number.
And completely ignoring the operational leverage and the de-risked balance sheet.
Pretty much. I mean, the stock drops over 5% after they raise the FCF guide by 61% year over year. That feels like, well, a potential mispricing of the company's floor value.
Okay, so what's the outrageous but plausible trade idea stemming from that?
The idea would be something like this. You initiate a long position in PROS stock, but you help finance that position by selling deep in the money put options that expire pretty soon, maybe 3 months out.
Okay, break that down. Selling deep in the money puts. You collect a decent chunk of cash, a premium, right?
Exactly. And that premium is likely high because the market is so skeptical right now. Skeptical about those AI agents getting adopted quickly, skeptical about bookings being smooth in Q3.
So you collect that skepticism premium.
And use it to effectively lower your cost basis on the long stock position you took.
Interesting. So it's kind of a bet on time.
It is. You're basically positioned to capture significant upside if things start to click, if that commerce partnership gains traction, if the AI pilots start converting into real usage, maybe scaling in 2026.
And the downside.
Well, the downside protection comes from that strong, reaffirmed FCF target, the $40 million plus, and the cleaner balance sheet. It suggests a certain fundamental floor.
So it's really a value play structured around the idea that the balance sheet gives the new CEO the time needed for these longer cycle growth plans to actually work.
That's the thinking. A bet on execution runway provided by financial stability.
Okay, so let's recap our deep dive then.
Right.
PROS delivered really strong execution, beat estimates, boosted profitability, short of the balance sheet.
And laid out a clear strategy focused on AI and partnerships to try and re-accelerate growth.
But the market needs proof. The next few quarters seem critical for internal execution risk. Management has to show that this new targeted sales and marketing spending is actually more effective.
And that those top-of-funnel improvements start translating into faster subscription growth, probably starting next year.
Yeah, it feels like the biggest variable now isn't even the macro stuff, maybe. It's that internal challenge. Can they actually convert those AI agent pilots from just pilots into something that generates real scaled revenue?
That transition from cool tech demo to monetized product feels like it will really determine if this whole strategic pivot works.
Definitely something to watch. Well, thank you for joining us for this deep dive. We really encourage you to keep tracking those key catalysts we talked about.
Yeah, keep an eye on the Q3 guidance commentary, any early feedback on those AI agents, and how that commerce partnership pipeline is building.
We'll catch you on the next deep dive.